Record button here. Okay, cool. It says we're recording. So let's go.
Welcome, everyone. Thanks so much for joining us. This is a really special American IRA podcast. I'm Sean McKay, and typically if you've been a part of any of our educational platforms, webinars, and podcasts, we typically go into some really specific self-directed ideas. But as I said, I'm really excited. This is something a little bit different than what we typically do. With us today, I have a friend, a mentor, unbelievable investor, a guy that's done incredibly well with entrepreneurship and real estate. With us, we have Chad Carson. Chad, thanks so much for being with us.
Hey, it's a pleasure, Sean. It's always fun talking, and hope we can have some good conversations for your listeners.
Yeah, absolutely. So I reached out to Chad a week or so ago. He's actually just released his new book, Retire Early with Real Estate. And so obviously I was hoping we could dig into some of those concepts today. And I just thought it was a great opportunity. We've had you on a few years ago, and it's just a really good opportunity for us to get the word out there about how we can build our portfolio and kind of some of the thought behind it as well. So, Chad, if you wouldn't mind, if you could just kind of give us a little bit of a background on what you've done to this point.
Sure. So my home base is in Clemson, South Carolina. So it's a little small college town. And about 16 years ago now, I think, maybe it's getting a little bit longer than that, I graduated from college. So I'm 38 years old now. And I was trying to figure out what to do with my life, like a lot of people who get out of school are trying to do. And I didn't exactly figure it out, but I sort of knew that I didn't want to go like the traditional route at that moment. Like I was a biology major in college with a minor in German. So the normal path was something in science, maybe medical schools. I actually applied to 5 medical schools, but I sort of put pause on it. I said, you know what? I think I'm just going to take a break. And I was fortunate enough to have some family members who had rental properties. My dad and my mom had rental properties. And so I was like just pulling books off the shelf and reading about it. And I was sort of interested in entrepreneurship and business. And more than anything, though, I just liked the idea that I didn't have to go to a job like with somebody else's office and do all that. So I decided to like jump into real estate investing full time right off the bat, which is a little crazy as I think about it. But I owned my car free and clear. I didn't have any payment on my 1993 or 95 Toyota Camry with cloth seats. And so I figured, that was pretty comfortable in the back seat. If I had to sleep there, I'd be okay. And I enjoyed eating ramen noodles, and that was fine. So, I jumped into it, and like long story short is I started off just flipping houses, like primarily like flipping, like buy low and sell a little bit higher. Like it's called a wholesale deal, where you just go out and find good deals for other people who actually have money, because I didn't have any money. And so I just got really good at finding deals, first of all, and just hustled and, learned the business. I didn't know anything about managing properties, about financing. I just like learned one little slice of the business. And then once I got that down pretty well, a business partner and I started buying and flipping the houses. So we would find people who would loan us the money, private lenders, self-directed IRAs. I was kind of early on that just because I had to, and I couldn't go to the bank and get a loan. So I really got good at using self-directed IRAs from other people. Like I would show them that, hey, look, you've got $500,000 in your 401k and you've left your job. Why not move that money over to a self-directed custodian and loan it to me? And I'll pay you. At the time, I paid them 10% interest for the loan they would make me. And then I would flip the house, pay them back, do it over again, over and over and over again. And so that's how I grew. I started off finding deals, flipping deals, and eventually we started buying rental properties as well, because what I found was the flipping and the wholesaling was great. You made big chunks of money, but it's also a job. You have to work, and once you sell it, you got to start over again. And so I really love buy and hold rentals and some of the income properties in real estate, because eventually my goal was to not have to spend as much time day to day, always having to, find more money. So that was sort of the big picture evolution of my real estate business. And, be happy to talk details within that.
Yeah, absolutely. So, obviously Chad's a really humble guy, and so he's probably not going to touch on all of these concepts, but just so that everyone's aware, Chad's kind of this interesting type of individual where he's been the super high achiever. He was a great college football player. He was a finalist for the Rhodes Scholarship. As you mentioned, you're pre-med. You've done a lot of these things that are really impressive on paper, but then what I find probably even just as interesting about your story is that you do a great job certainly through this book, certainly through your website, coachcarson.com, of also giving us perspective as investors and entrepreneurs as well. And one of the things that you touch on a lot that I think gets lost as we're trying to build our portfolios is this idea of enough. And can you kind of explain how that fits into the plan as well?
Well, thank you for saying all that. What I will say is that I figured some things out for myself, but it wasn't like I had it like in my head ahead of time. It was like me bumping up against a wall and making mistakes and doing too much. And so like the story for me is, I started in 2003, as I just was explaining to everybody. And so we grew really fast. Like after a couple of years of kind of puttering along, we finally started buying deals and buying and selling. And by 2007, so that's like 4 years later, we got really good at finding deals and really good at raising money. And so we actually had like 50 closings where we acquired 50 different properties. And some of those were multi-units, so like multiple houses. And so like we were like super busy. And it was, I think the good thing about that was like we made a lot of money flipping houses. We had some good deals. But the realization for me is at the end of the year, we're kind of like, wow, this is a lot of houses. We also saw the kind of the storm clouds on the horizon. 2007, 8, 9 was the Great Recession, the biggest real estate downturn since the Great Depression. And so all of that combined, my business partner, Tommy, was probably smarter than me in this case, was like, we just need to step back and like kind of look at what we're doing. And we did something that I now encourage everybody to do from the beginning is like, think about, what is it we are actually in real estate investing for? Like what kind of life do we want? What kind of specific goals? What kind of lifestyle? And like what we basically did, which is probably common, like we went to seminars and classes and we were very impressed by the people we saw. Like there's a person who was flipping 50 houses a year, had these big operations and was finding deals. And we're like, wow, that's cool. And we were at the class and we're like, we could do that. Like, here's what she's doing and here's what he's doing. And so we just copied it and modeled it, but we were sort of borrowing other people's goals instead of like doing the hard work of thinking about like, what do we want our life to look like so that we can build a business that actually, and in real estate investments that actually serves that. And so that was sort of the, bumping into the wall thing. We just sort of realized that as we were there, and we had to do a lot of, hustling to make sure we weren't too exposed in 2007, 8, 9. And so we survived the downturn primarily by being frugal and just having a lot of cash saved and hustling. But we also reset kind of pivoted with our goals, and our future path wasn't that we weren't going to grow. Like we still want to grow, but we saw it more like we're climbing a mountain, and like the peak of the mountain is like your big time financial goals. Hey, I want to eventually have enough passive income from my rental properties to pay for all of my lifestyle and have plenty of cushion. Like that might be the peak. But at the bottom of the mountain, as you're climbing, we sort of, the traditional model we saw was you just climb until you get there, and then you can take some time off, like retirement. That was the idea of retirement. And I actually read a book called The 4-Hour Workweek back in 2006, I think, or 5. And it's been a really popular book. But the concept in that book was that maybe you shouldn't wait till the end. Like maybe you should take some plateaus along the way. And the specific term for that was like mini retirements where, take those things that you're imagining one day will be wonderful. And why not like sprinkle those throughout your life? And it might start with like a 1 or 2 week trip. It might continue on to a month-long trip, or for us in 2009, like pretty soon after we had that realization, my wife and I took a 4-month kind of backpacking trip. We didn't have kids at the time, and we went to South America. We went to Peru. I learned how to speak Spanish. We went hiking in Patagonia in this beautiful like southern parts of South America. And so for us, like it was travel. Other people, it might be like taking time off to go get a new degree or start a new job or be home with your kids or plant a garden. Like there's all sorts of things that we would love to do someday. And those are kind of at least in my experience, people tell me those are the things they're doing real estate investing for. That's why they want to make money. And so I've sort of made that my personal kind of goal is to try to find those things and build my business around it. And also just my mission with this book and with talking to people and getting out to help people do real estate investing is let's build that entire business with that kind of mindset as a starting point. Because if you do, then the tools of real estate, of self-directed IRAs are awesome. Like it's like a toolbox that is the best toolbox I've ever found, but it's going to be helping you build and construct that life that you think is awesome, and you'll have a purpose and you'll have a deliberate kind of blueprint as opposed to doing what I did and just sort of haphazardly buying and selling houses just because it makes money.
Right. Right. No, that makes sense. And it's unfortunate. And I've certainly fallen into this at different points. But as you said, a lot of us think about retirement or even financial independence as like a light switch. It's either on or
Mhm.
off. You're either
Right.
there or you're not. And I love that you talk about the plateaus and that there are those phases so that you can make sure that you're doing things that are important, and it's not we'll get to that 20 or 30 years down the road sort of thing. So I think that's cool, and that's once again the perspective part that we talk about. And if you don't mind, so I think about a lot of the investors that are either clients of ours at American IRA or people that we have the opportunity to meet at different investment groups and things of that nature. And certainly there's a wide range of people that want to use real estate to improve their lives, right? They might be
Mhm.
60 years old and realize they don't have savings. So your book Retire Early might be, well, let's spend the next 10 years getting to a point where we can do a bit better than just the Social Security, right? It
Right.
could be for the 20-year-old that has a lot of ambition, that doesn't want to work past their 20s or 30s, whatever it may be. And one of the things that I was lucky enough to kind of get turned on to with you and actually with our owner was the idea of house hacking when we were initially getting into it. Could you kind of give us a little bit of a flavor of what that can look like for us?
Yeah, you and Heather did an awesome job, and we're a great example of that. And so, house hacking is sort of like a gateway to real estate investing. And just so people don't think we're like talking about something illegal or like going out and like hacking your computers, what we mean is by like instead of just buying a residence, like the white picket fence, big huge house, and big mortgage payment, that kind of is the American dream for a lot of people. I'm a big advocate, and this is probably like my biggest like stump speech that I give as much as I can, is that or especially early in your life, but you could also do it later in your life if you're flexible, is to move into a property, into a house, a duplex, a triplex, quadruplex, some kind of property that has more investment qualities where you could actually generate income from the property that you're living in.
Hmm.
And there's a ton of different variations on how you can do that. Like the classic way is just to live in a duplex like you guys did, and you live in one unit, you rent out the other unit, and in many cases you can cover like half or maybe even all of your mortgage payment depending on what the price and rents are. And so like benefit number one of doing that is that you're reducing your operating expenses for your life. Like
Hmm.
if you're somebody who's new to a job, new to being an entrepreneur, or you're growing your wealth, like the number one thing, whether you're investing in real estate or doing something completely different, is you've got to save money early on. Like that, anybody who studied compound interest, like if you have $1,000 today and you invested at 7%, I don't have the financial calculator in front of me, but like that turns into like huge mountains of money if you let that compound over time. And so if you can save some money with your housing expenses, that gives you some freedom, some flexibility to reduce your overhead, save more money, put it into whatever you're going to put it into. So that's benefit number one of house hacking. But the other benefit is like if you want to get into rental properties, acquiring that rental property and finding it and learning how it works is kind of a tricky part. And so I'd be interested in what you think, Sean, because you did it. Like for me, it was sort of like a way to learn the landlording business without the pressure of having this like new rental property that I don't even live there. Like you're there, you're observing the property. If you can kind of do a little bit of hands-on work if you want to. I'm not super handy, so I didn't do a lot of that. But I fixed up the lawn, I did the landscaping, I talked to that it was a location that I was willing to live in, so I knew I would attract tenants who were hopefully similar to kind of my values and what I was trying to do. So for all those reasons, it's a super easy way to get into the business. And then later on, in my case, like my wife and I got married, and she moved in with me in unit number 2 of my little fourplex. And then after a couple of years after we got married, we decided to start a family and have kids, and it was a little bit too small. So
Hmm.
then we moved on, but we kept the building, like we kept the rental. And so people can transition from a house hack to a regular rental property that has long-term financing, that is probably in good shape. The property well. And so like I'm an advocate for like, if you could do that like 2 or 3 times, just do 2 or 3 house hacks, that might be all the properties you ever need. Like that might be a
Yeah.
way just to build your portfolio. And then you can go do whatever you want. You can live in the dream house, you can do those other things, but just a 5 to 10 year period of your life can make an enormous difference if you do things a little bit differently than everybody else.
Sure. No, that makes a lot of sense. And, I think certainly the common thread there is, as you said, you did it, when you were in your 20s. We did that when we were in our 20s. Not to say that you can't do it later on
Mhm.
in life, but I think psychologically, especially if you're, newly married, something like that, perhaps it's a bit easier when you're starting
Yeah.
on that plane because, a lot of us came from apartments or whatever if
Right.
we're coming out of college. So it's pretty similar to the lifestyle we're used to. So yeah,
Yeah.
it's a nice, easy transition, right? As opposed to you live in the 3,000 square foot house and then you tell your spouse, by the way, we're going to live in a 900 square foot,
Yeah.
quad or whatever it may be.
Yes.
That's tough, right?
Yeah. Well, I mean, to me, one of the craziest things is that here we are, these people getting out of college or high school. They've been living in like their parents' spare bedroom, or they've been living in a dorm room, like sharing room. And then they're going to go buy like a 2,000 square foot house with 3 or 4 bedrooms.
Hmm.
Are you kidding? With a big mortgage payment? Like,
Right, right.
all of a sudden you've arrived when you've done that.
Hmm.
Like that's not the path to actually getting financial independence. Like, and like that one decision, like if you didn't ever invest it or anything else, like if you just got your housing right early in your life, it's a massive difference. Like I've written articles on the compounding of what that difference could be. It's like $500,000, 750,000, maybe even $1 million, depending on the cost of your housing,
Hmm.
getting some of these decisions right. And so like it kind of sounds simple, but like if you can get your housing right, either doing a house hack, or for those people who say, look, I am not living next door to my tenant. I don't care what you say, Chad and Sean, that's just not cool. Like you can do some variations on it. Like just move into a house that could be a rental later on once you move out. Like just buy a simpler house and run the numbers as if, 5 years from now or 3 years from now, when you move out, that it will still cash flow as a rental. And so you can live in the house. You don't have to rent it out while you're there, but just plan on having a house be an investment instead of it just being kind of a dead weight, financial dead weight around you. Like I think that's the message we're trying to get out there.
Absolutely. When I love that you're essentially a pretty frugal guy. You talk about keeping the housing expenses low. You and I have had some pretty crummy cars, even though you've done extremely well, and you can certainly afford to have a nicer car. We sometimes have some of the least desirable cars in the parking lot at events, and I love that you're sticking with that path. And obviously we're everyone makes upgrades throughout their life, but you've
Sure.
kept this reasonable level of a burn rate, if you will. And I think that's sometimes so underutilized of a tool for us as investors, especially as we're really in that mode of trying to grow and trying to accumulate assets. It's amazing the difference between having an $800 car payment and not,
Right.
right?
Yeah, and it's been a mindset shift for me. Like I know when I mention frugality or something like that, people are like, look, like I work my tail off. Like I want my nice car, I want my nice
Hmm.
house. Like I mean, I get that connection. Like you are working hard, therefore you deserve something good. But like to me, it's like, what is that good thing you deserve? That's the disconnect. Like so for me, is like I love flexibility and freedom more than anything. Like you can't get me like a Mercedes Benz that does like it's not even close to what the flexibility and freedom you can have. And so like basically by being frugal and for me, it's like just frugal on housing and frugal on your car. Like those are your big, huge expenses. Like we still like to go out and eat. We just don't do it every night.
Hmm.
It's just being a little bit more deliberate because I can see like the return on happiness of those choices. Like, so I've been for 17 months abroad and traveled and seen where that money can do for our family, and seen me not having to go and have the pressure of going to a 9 to 5 job in my 30s. Like I've just seen how awesome that stuff is. And so for me, it's like, this is not like suppressing my happiness. This is like encouraging my happiness by being more flexible and being simpler and being more deliberate about my life. And so I think that mindset shift is like, what are you buying? Are you just skimping and not saving money so that one day you can be happy? Or are you like buying your happiness and buying your flexibility and buying your freedom by not buying that big, super expensive thing? Because the math is like, is foolproof. Like if you buy those big things, if you buy that $40,000-$50,000 car early in your career, if you buy that $300,000 house when you could buy a $150,000 house, like you are making a huge financial choice. Like you're choosing that as your happiness. And if that's what you want, that's cool. It's just like, but you're not going to build as much wealth, and you're not going to have as much flexibility and financial independence as early as you could. So it's like, it's just a choice. It's like, just make choices, open eyes. And if that's what you want to do, there's no like judgment there.
Sure.
But I think so many of us, myself included, kind of take the path because that's what the culture says. That's what everybody else does. And so I think what I'm trying to do is just get the message out there that you don't have to do that. And in fact, there's some really cool things you could do with your life if you make some different choices.
Absolutely. You're picking your spots, and that doesn't define your success, right? Because you have the $60,000 car, you're not more successful than, someone driving the $12,000 car, whatever it may be.
Right.
So I love that. And I love that you're the successful younger guy that's, delivering that message. So you've talked a few times about the self-directed concept, and, we appreciate that at American IRA. Obviously our service is self-directed IRAs and 401ks. And one of the things that we're always looking to improve when we're spreading that message is what you kind of alluded to, of this idea of almost thinking about it through two different prisms, right? There's the ability to grow your retirement account through alternative assets, but then there's also the ability to grow your, in this case, real estate business using other people's retirement accounts. Can you kind of give us a little bit of a flavor of what you've been doing specifically?
Yeah. And by the way, I mean, this isn't a paid plug. Like, Sean didn't give me some money under the table beforehand. But American IRA has been awesome. And you guys I've been using you. I used another company in the very beginning, and then I met you guys and have been super happy, and has been a big part of my own wealth building journey. And to this point of what you just asked, like, I send my private investors there. Like, I've had other private investors who had money, and they're like, where should I go? And I'm like, well, there's only one place I would go. And so I work with you guys and love what you do and your organization. Nice. And so like what I think starting off, like I'll go earlier, I mentioned how when I got started, finding the money for my deals outside of my IRA. So like just me building wealth, buying flips or buying rentals, I had to go to other individuals to get my money. And by far, like the number one tool in my toolbox of financing that I've used over the years has been borrowing money from someone else's self-directed IRA. Mm-hmm. And I think it's such like a natural, underutilized tool. It's so simple, but the idea is, like, if you can go to the bank and get a mortgage and get a 5%, 4% mortgage, like, that's cool. Like, there's no problem doing that. But at some point, either whether you buy a house that's a super big fixer-upper and the bank won't loan the money on it, or maybe you get to like 3 or 4 houses and the bank cuts you off. There's some number between 4 and 10 where the mortgage companies typically cut you off. At that point, your choice is like, go to a commercial lender who's going to give you like a commercial loan, and you're kind of getting into another territory, or you go to private lenders and you kind of build your own source of financing. And that's the angle I went to, just sort of stumbled upon it a little bit, and has made like all the difference in so many different respects. And one of the most important respects for me was, like, I started doing that in 2003, 4, 5 when I first started, just because I had to. But as we got into 2007, 8, and 9, it was really interesting because the market changed, and people were panicking in all the markets, the stock market, the real estate market, wherever. But at the same time, like, what's Warren Buffett's quote? What's he do when other people get fearful? What's he do?
When people are fearful, he gets greedy.
Yeah. Meaning, like, when everybody was panicking in the streets, he was out buying. Yeah. And so for us, like, we were kind of, had to do our own things of making sure our rentals were okay and all that. But we also bought some of the best deals we've ever purchased in 2009 through 2015, basically. Mm-hmm. And almost all of those came from using a self-directed IRA loan from an individual. And it was a super interesting dynamic because there was not a lot of bank money out there to go buy these deals when the best deals of the century were out there. And so in my private lenders who had the money, they were not real interested in like going in the ups and downs of the market. They were all kind of panicked a little bit too. And so it was a super mutually beneficial relationship where I could go buy a really good deal. My private lenders could have a really low loan to value, safe investment, and they could get interest from me without having to do any of the work, any of the hassle. So that relationship of the borrower, entrepreneur who's trustworthy, who finds good deals, and the private lender who has money that they want to put into a deal with a trustworthy person on a good piece of collateral, like, that formula is just awesome. And so whether you're the lender or whether you're the borrower, like, I think that's most of what I've done. Like, both sides of that has been kind of my kind of cookie cutter. And even to this day, like, trying to think of a deal, we just closed on a property this year, 2018, self-directed IRA, loan the money. So not much has changed. And I pay a little bit more interest. Like, in my case, I pay my private lenders 6% interest. It's sort of it's come down since I paid my 10% in the very beginning. But part of that has been track record and trustworthiness, and they know I can perform. Part of that is also these are longer term deals. Like I'm not getting in and out and flipping a house anymore. It's something that I'm going to hold long run. And so these investors see me as sort of, they compare it to like, all right, I could go put this really safe money on this property and with a guy I know at 6%, or I could put it in the bank at 1% or 0.5% or get an annuity. And so it's an income play for these retirees who they need a place to get income and to pay for their lifestyle. And I'm providing them a consistent, steady source of income over and over and over again. And they're using it to live. Like I've talked to some of my long-term lenders and they're like, yeah, your payments through to my IRA, I take those out every year and that's what we use to pay for this or that. And it's been super, like, it's just fulfilling to know that you have this business that is helping someone retire, someone else. I just think it's such a cool concept. And it's like when I talk to people and they've never heard of self-directed IRA investing, they're like, am I going to have to like pitch this to people and like convince them to do it? And I said, look, if you tell them like what's really going on here and they really see it and they really trust you, like this is a no-brainer. Like this is not a hard sell. This is an awesome kind of win-win kind of relationship. So I'm a big fan of self-directed IRA investing. Obviously, it's worked well for me as a borrower. But then I'm also, I have about these days 50% of my wife and my kind of retirement money in self-directed investments. The other 50%, I'm kind of diversified, and I'm so heavy in real estate that I'm kind of interested in also getting some equities and index funds and just having some of the other stuff too. And I think that's sort of normal. I think most people have some in real estate, some other places. That's a good long-term strategy. And so, but it's worked for me as a borrower. It's worked for me as an investor, and I can't say enough about it.
Yeah, no, that was great. And, certainly one of the things that hopefully everyone picked up on in that discussion was that some of the times, at least, you're using notes and you're creating long-term mortgages with these people's retirement accounts. And I think a lot of entrepreneurs have this mindset where they think that these retirement accounts are useful to fund a flip, where it's going to be a very short-term activity. But we certainly see a lot of entrepreneurs like yourself that are creating 5, 10, 15-year notes with these private lenders. And as you said, some of them actually don't want to get paid off, right? I mean, this is a stream of income. They don't want to have to worry about reinvesting it somewhere else. And so I think that's a great message to get out there as well, is that you can be creative, you can be flexible, whatever you want to call it with the terms, as long as it works for the borrower and for the lender. So that's great. I appreciate you kind of sharing that with us.
No problem.
Yeah. So as we look at the book, phenomenal book. I love kind of the structure of it. You did a really nice job of articulating, some of the things that we've just briefly touched on with the mindset and, really kind of start with what are we trying to accomplish and we're working backward. And then you have these case studies, if you will, kind of these elongated case in real estate. And ultimately, there's some concepts that I think at least some of our clients are not necessarily as familiar with. And so if you wouldn't mind just kind of helping us, one of the things that I think is something that's talked about on Bigger Pockets, for example, a lot, that maybe some of our clients that aren't on that aren't as familiar with, as the concept, if you will, something that Brandon Turner has kind of coined at Bigger Pockets. Can you kind of help us unpack that a little bit?
And which strategy was it specifically that Brandon talked about? I know he's got a cut, like there's the BRRRR strategy and there's some of the other ones. Which one they're all pretty cool, but
yeah, the BRRRR strategy, if you can kind of articulate that a little bit.
Yeah. So I'll say the word slowly just so everybody can understand. So it's an acronym. It's B. Let me make sure I know how many R's there are. Like BRRRR. Like there's just a bunch of R's. So remember that, like, you're cold, you're doing this deal. So it stands for, you buy a property. So typically it's going to be a rental property. You buy it, and it's usually a fixer-upper. So this is a lot like a flip deal where you would buy it, fix it, and flip it, except for you're going to keep it in the end. And so you buy this fixer-upper, you remodel it. That's step number 2. That's the R, first R. You rent it out. So you get it rented, you get it stabilized. It looks beautiful. It's hopefully the value's higher than what you bought it for. you refinance it. And so that's the key is, so like, this is where self-directed IRA funds come in for me in many cases. So like when you buy that really big fixer-upper property, it might, there are some loans out there you could use, but like, to me, like buying with cash or a self-directed IRA fund, a private lender is much better than trying to buy with a bank, because you can't move as fast with a bank. Whereas American IRA, y'all, probably the fastest deal we've done is like, for me, like 5 days, like on a Monday and you guys closed on a Friday. I mean, that could happen if you get everything in time and get everything lined up. So typically it's more like 3 weeks or so. But, and so you can move fast. You can use self-directed IRA or private money to buy the deal. You remodel it, you get it rented out, and then you refinance it. And this is the cool part. Like, in one of the first bird deals that I did, I had about $120,000 between invested in this property. And that was between my cash, private lender, I got a local bank loan. So it's just a kind of a hodgepodge of kind of short-term money. And then, but I had increased the value of the property to about 160. So 120 invested, 160. That was a good deal. I got a lot of equity. But the cool thing was, once it stabilized, and it depends on the bank, but usually 3 to 6 months later, you can go and get an appraisal on that property and refinance it. And, you can usually pull out 75%, 70 to 80% of the value of the property. Mm-hmm. So I was able to pull out 100% of the money. Like, I got a new loan for about 120 grand. And so I got all of my money in the private lender and the money back. I paid them back. And now I have a long-term, in this case, I think it was a 4.5% loan on this property that's worth 160 and I owe 120. So I now have good cash flow as a stabilized property. I've got all my cash back. And then what do I do now? I go repeat. That's the last R. I repeat this whole process and I buy another property. And so for those of us who want to leverage some cash, I mean, this is not for everybody. Some people see all that and they're like, that's super risky. I'll never do that. That's crazy. But for the entrepreneur who wants to take a limited amount of capital and leverage that and turn that into like 5, 6, 7 rental properties that will be good long-term investments, using the BRRRR strategy is an awesome way to kind of get that ball rolling and turn that 20 or 30,000 bucks you have maybe as a down payment into 5 or 6 properties. Mm-hmm. And so I kind of see it as a good starter plan. That's why I put it in the starter plan part of the book, because I don't think you want to BRRRR forever. Having 100% leverage and doing that forever, going back to like why we're doing this in the first place and having enough. Like, I think at some point you want to start like transitioning to a sort of more of a retirement plan. But the BRRRR strategy is really awesome for buying properties, getting your portfolio kind of stabilized and set up, and then you can transition to a point where you start. In my case, I like to start paying off some of those properties and trying to get some of them free and clear. Maybe not all of them. I'm kind of in between. I don't have all my properties paid off. I have some of them paid off, some of them not. But you can start transitioning into more of a retirement mode once you have enough properties that could support you later on in life.
Right. No, that makes sense. And so, certainly there's going to be some people that are going to listen to this and they're looking for those nuggets so that they can go from zero to financially independent in a very short period of time. Mm-hmm. And one of those concepts that you talk about, where maybe there's some more moving parts, maybe there's a bit of expertise needed, but it can be really useful, is the idea of the 1031 exchange. And so can you kind of give us the fundamentals of how that looks?
Yeah. So similar to the BRRRR plan, this is a really good way to grow your wealth, like to go from like a small amount of capital to a bigger amount of capital. And what we mean by this is like, think about like sort of like dominoes. Like, you start with one little domino, and if you can line things up correctly and you can put some bigger dominoes, like you can the small domino would knock over a bigger domino, which knocks over a bigger one. I sort of see 1031 exchanges, which is basically trading one property for another property. That's what that term it technically means, and doing it in a tax efficient way. Like, so a 1031 exchange is a section of the IRS tax code that allows you to, if you follow the rules, you can sell one rental property that you have, one investment property, and you can replace it or buy another one and not pay any taxes on that transaction. So you don't pay taxes on your depreciation recapture, which you normally would, which is a big deal. You don't pay any taxes on capital gains if you've bought it low and sold it high. And so you're getting basically, let's say I'm about to do my first 1031 exchange here in the next month, and I have about a $20,000 tax liability on this property. And so that $20,000, if I can use that 20,000 and not give it to the government today, which they allow me to do legally, then I can spend that money on a new property, which produces income, which produces wealth. And so I'm basically using, leverage money. Like I'm borrowing the money from the federal government, and I'm using it to buy my rental properties, and I'm using it to grow my wealth. And you do have to pay it back maybe someday, like in the future. Like if someday, if you decide not to do a 1031 exchange, you would pay all the accumulated taxes that you've deferred basically by doing these 1031 exchanges. But if you're a buy and hold investor who plans on holding these for a really long time and not selling them, you could actually die with these properties, and your heirs would get what's called a stepped up basis. Meaning, like if the properties were worth $1 million, your heirs would inherit those properties basically at the value at the time of your death, instead of that really low basis that you had from buying them all those years. And they would not pay. They could sell them tomorrow and not pay any taxes on them in terms of like transaction taxes. So it's a really cool tax advantage strategy. It requires more entrepreneurship. It requires more timing. It requires some knowledge. You're going to need to hire some experts, some 1031 intermediaries to help you do this. This isn't a DIY kind of thing. You need to get help. Just like self-directed IRAs, you need to get help. But if you can handle it, if you can do it, if you're more entrepreneurial and you can find good deals, you can grow your wealth and compound your wealth really quickly and end up in a place where you have this portfolio of properties that produce a lot of income.
I love it. Yeah. And and as you said to me, there's certainly, I'm sure, a multitude of uses for it. But as you said, you can either just simply trade to a better type of rental property. So maybe you have the crummier rental that's tough to rent, what have you, and maybe you can sell that and exchange into a property in a better area that's very easy to rent. Maybe the cash flow is a little bit better, but ultimately you're just getting an inferior asset out of the way for a superior asset. And then I've also, you've talked quite a bit over the years about, multiplying as well. So maybe you're starting with one house, and through a series of exchanges, you could end up with 100 units or, however many hundreds or thousands of units, depending upon your, risk tolerance and timeframes and what have you. So that's a phenomenal tool. Certainly not anything we do at American IRA. That is a question we get asked a lot. But as you said, there's some really quality intermediaries that can kind of babysit you through the process. Heather and I did a few last year, and we had a great intermediary. We knew nothing about the process going into it. All we knew is we were trying to not pay taxes, and they were great. And it was not overly complicated, as long as, like you said, you just kind of follow that process. But yeah, thanks for kind of helping us unpack that.
Sure.
You touched on the idea with the BRRRR strategy, where maybe you're not doing that forever. Maybe you get your portfolio to a certain point where you like the amount of units you have, you're kind of set, it's enough, as you talk about. And, selfishly, one of the things that Heather and I have really taken to and think that it can be a useful idea to at least consider is you talk about the debt snowball. And, if you can kind of help us understand how that can be utilized as well.
Sure. So I like how you set that up. So again, remember our mountain metaphor, like we're climbing a mountain. Financially, we're trying to get to this point where basically our wealth can pay for our lifestyle instead of having to work at a job. That's sort of what the peak we're trying to get to. And real estate is the path we're taking. And there's some kind of core paths to get up the mountain. And we've already gone over the first step. There's different ways, but you accumulate a certain number of properties. And this is where you take that lesson that I didn't learn early on. You look at these properties and say, all right, look, I've got 7 properties, or I've got 10 properties. And you run some numbers on those 10 properties and say, you know what, if those were paid off, if after paying all my normal expenses, except for my mortgage, like if I paid taxes, insurance, maintenance, management, whatever I have left over before I make my mortgage payment, if I didn't have a mortgage on that property, what would that number be? And let's just say it's, let's just say it's $1,000. Like you had a $1,500 rental, and maybe those numbers don't work exactly, but just from round numbers, like for my math, like $1,000 is what you have left over. If you had 10 properties, that's $10,000 like a month if you weren't making mortgage payments. And maybe those numbers are like in some smaller markets, maybe that's 500 a month is what you have left over. So you have 10 properties that times 500 a month, and you have 5,000 a month.
Mhm.
So you look at that and you say, all right, right now I'm not making $5,000 a month because I still have mortgage payments. But what if in 7 years, 8 years, if I really accelerated my mortgage payments to get to this plateau where I've reduced my risk, I don't have as much, don't have the debt hanging over my head, I don't have mortgage payments going out, I've simplified, instead of having 50 properties, I have 10 properties, and I'm increasing my cash flow. What if I got to that plateau by just paying these things off? Then, and if 5,000 a month like paid for your bills, like you'd have enough. You'd be set. You'd have rental properties that covered your expenses. If they were in good locations, they had the tendency to keep up with inflation. Like there's no guarantee, but at least in my experience, that the houses and better properties I've had have kept up with inflation over the last 16 years or better. And so that's a game plan. Like start with that idea, work backwards, and say like, how could I get there? And a debt snowball, which is a lot of people are familiar with, like from personal finance, like in Dave Ramsey and different things, where you basically, what you do is you take all of your cash flow from your rental properties and every bit of savings you can muster from your job, from flips, whatever. And instead of spreading that cash flow out over like all 10 properties, what you do is you concentrate 100% of that on one property at a time. That's the magic. That's the magic pill, is that you do all of that. And so instead of having like a $500 mortgage payment, you now have like a $5,000 mortgage payment or a $3,000. And so I like super accelerating that payment. You'll pay off the first mortgage maybe in 3 years or 2 years. And then what happens after that? You've now freed up another $500 to add to the snowball. And then the second mortgage gets paid off a little bit faster. And then now you got another mortgage paid off, and the third mortgage. And so that's the snowball. Or some people call it an avalanche. It starts taking off on its own. And I've run lots of numbers on these scenarios. It depends on what your rent is and what your mortgages are. But within 7 to 12 years, if you really concentrate and stay disciplined, you can get to a point where you have a big chunk of money paid off on your portfolio. And I just like pause and think about that. Like how many people are like working for 30 to 40 years to get to a point where they have enough money to retire? And here we all are talking about staying disciplined for 7 to 12 years. I mean, that's really amazing. Like I still have to wrap my head around that sometimes, to get to a place where your portfolio pays you for the rest of your life in a very conservative, safe way. That's why I'm such a big fan of it, because it's a solid plan. It doesn't depend on appreciation or some of the other things happening in the market. It just depends on you saving money, being disciplined, keeping your properties rented and taken care of, paying off that debt. And there you go. Like you have a lot of control over this retirement plan, and it's a super solid place you get to in the end.
I love it. And I love how you can ladder these concepts. So if we're starting, let's take that, say, 25-year-old who has a decent W-2 job. They're not setting the world on fire, but they're able to save some money. And maybe they start with the duplex. So they're kind of house hacking. And they spend the next few years accumulating some rentals with a small pile of money, or relatively small pile of money, and they're doing that BRRRR strategy, right? So they're accumulating and they're kind of recycling that money, as you spoke about. So they're taking that same 30 or 40 or 50 grand and they keep rolling to accumulate. And maybe over 3 years or 5 years, they can accumulate that base of properties. And then, as you said, if someone can take the next 7, 10, 12, maybe 15 years and then be able to plow down that debt, that's, you're cutting your work life, if you will, in half compared to, the typical Americans, work history and what have you. So it's phenomenal. And that's not aggressive, right? I mean, no. People, you've done things much more quickly than that, but it's just cool, like you said, to show the power of how these things can kind of tie together.
Yeah, I mean, you and I are both kind of like real estate nerds, so we get excited. We get super excited about this, and I think it is exciting. And I think when people catch on to the idea, but I just also want to mention like that end goal. Like we talk about not working and retirement, and it's sort of a loaded word, right? Like I really thought about using that. Should I use this word in my book, because it has so many connotations for people, and some of them are like, I don't want to, like for entrepreneurs, like I don't want to stop working. Like I love being productive and helping people, and so I just want to point out that like I am not like sitting around twiddling my thumbs and sitting on a beach sipping pina coladas, although that sounds cool every once in a while. Being in a place where you don't need to work for money is amazing, because you have leverage on what you do with your time. And like, I just challenge you to think about what your job would be like if you love your job. Like if you have a career that's like fulfilling and but could there be, would you renegotiate something with your current job if you didn't need the money? Yeah. Like if you could go into your boss and say, you know what, like I love doing this, but I'm not doing those meetings, and I'm not showing up on this day. I'll show up Monday through Thursday or Monday through Wednesday, and I'm not going to get in at 8 o'clock in the morning. I'm going to get in at 10 o'clock. Like just think how you would tweak your life, even if your job is fulfilling and wonderful, you could change it all. And that's been my experience. Like I love contributing. I love using my skills. I love having projects to do. I love real estate investing. Like I don't plan to stop doing that. But I love writing books and I love being with my kids and I love traveling. And so that's like going back to the beginning of our conversation, like what is that thing that if you could change it in your life, like you could stop doing something that you're doing right now that's not fulfilling and happy, making you happy, and you can kind of fill that space with something else. Like, there's some tweaks you can make. And that's like, that's the exciting, that's even more exciting than the nerd stuff that we like to talk about with the specific mechanics, is like, it can get you there, and it can get you there in a much shorter time than you're usually sold over the long run. And it doesn't have to be like crazy, risky, wild kind of stuff. Like real estate is a tool that you can have a lot of control over. You have to get involved. You have to learn some things. It's not like a magic, pill you take, but it is something that if you're diligent and you're disciplined and you hustle, you can do it a lot faster, and you can get on with your life and change things rather than waiting and kind of letting life happen to you. That's what I'm excited about. That's why I'm talking to people about it, because I've done it, and I interviewed 24 other people in the book who did it, and I meet people every day who are on the way to doing it. And so I just want to let people know out there that like this is not only possible, but like here's a blueprint to do it.
I love it. That's so well said. And if I could even just tag on a little bit at the end with this also being something that can just simply be, if nothing else, a safety net for you and for your family. Mm-hmm. Excuse me. For me, I love my job. I love getting to spend time learning from investors, from entrepreneurs. I love, hopefully adding value with the retirement accounts. But what if my company gets sold, or, Jim decides that Sean's not as valuable today as he was 5 years ago or 10 years, whatever it may be, right? And so if you're doing these sorts of things, you can enjoy your work life. And like you said, maybe you can negotiate things that are kind of optimal from a time standpoint, but it can also provide that safety net so that, if you fall off the wire one day, the consequences aren't dire. So no, I love it. I appreciate that. And, obviously you're a busy man. You're running like crazy, spreading the word about the new book. If you don't mind, one thing that in 2018 that's kind of widely discussed, and something I wanted to get your feedback on, is this idea of, are we going to see some sort of market crash? Is there going to be a huge softening? What's the future hold? And should investors maybe sit on the sidelines if they haven't gotten started with real estate investing or whatever it may be? So, if you could just kind of give us your thoughts on that.
Right. So, I mean, the first reality that we all have to acknowledge is that like real estate absolutely goes in cycles, right? And so does the economy, but particularly real estate is typically 7 to 10 year cycles. In 2018, we've been on like a 10-year tear now, I think. And so like we've been on a longer cycle. And so I know understandably people are like, hey, something's going to happen. And I'm so bad at predicting. Like you saw how well I did in 2007. Let's buy 50 properties right before the Great Recession. That's great. So like take it for what it's worth. But like my approach is to like, on the one hand, acknowledge reality. Like we have a recession coming, like something's going to happen right around the corner. I don't know what it's going to look like, but like recessions happen. It will happen. On the other hand, though, like we can't stick our head in the sand like an ostrich and just like say, oh, I'm just going to wait, or I'm just going to save my money and I'm not going to do anything for them, because maybe we think it's going to be a year or two, and it really is 5 to 7 years. Just to give you anecdote, like real examples, like in Canada and Australia, which are really high price markets at the moment, they've had tears of like 15 to 20 years where the markets continued to go up. Like things have not changed for the real estate market. Everybody keeps saying, oh, it's got to correct. The fundamentals aren't good. And, I agree with them. Like at some point this can't go on, but you're kind of in a losing game when you try to predict things exactly. And so here's a better approach, like, or at least I think like a more logical approach, is to always be prepared for these worst case scenarios. So, all right, here we are in 2018. Maybe there'll be a recession a year from now. Maybe it'll be 5 years from now. But what can you do as a real estate investor and as a general kind of person who's interested in financial independence and doing better for financially to prepare for that inevitability? Well, you can make sure you have sufficient cash reserves. That's like a big one. That was the number one thing that got us through having leverage and going into a really scary time financially. So have like extra, pad your cash reserves. Don't spend every bit of money you have on growth right now, and save some money. If you're personally 3 to 6 months of your living expenses is sort of what people recommend. And depending on your kind of risk tolerance, somewhere in that window, but you shouldn't have 1 month of cash reserves. You should have 3 months to 6 months. In your business, same way. Like I'm a little bit more, I'm on like more closer to the 3 month end, but I look at how much rent I need to produce in my business to cover all of my kind of operating expenses and my mortgage payments and everything else and our living expenses. And so I at least want to have 3 months of, if I got no rent tomorrow and for the next 3 months, like I have a big cash cushion in my business. And so I think those are like prudent steps for everybody, no matter what. And so like do that. Number 2 is like, don't stop buying properties. Try to, but be more diligent about finding deals that make sense. Like, everybody, it's kind of dangerous when you think about 2008, 9, and 10 and how easy it was to find deals, because some people are sitting on those deals like, wow, I bought a deal for that price and it was so awesome. And I know you did, Sean, and we've talked about some of the deals. You're like, gosh, those are just amazing prices when I bought them in Charlotte. I was the same way, but like, you can't look at today and say, I have to do the same thing I did then. But you just have to be disciplined with your cash flow, disciplined with your numbers. Like, you don't want to overpay and be stupid and do stupid things, but you might not get the home run that you got in 2008 and 9. You might get a single, you might get a double. And so like, I'm always like thinking, number 1, about my risk. Like I don't ever want to buy a deal where I'm exposing everything else I've done to excessive risk. So I don't want to get crazy financing with 1 or 2 year balloons. I want to have like balloon notes that I have to pay them back like way out in the future so that I can kind of ride out some storms if I do use financing at all. And then just making sure it's a solid property. Like the thing that we did the worst in 2007 before we hit the Great Recession was the 20% or maybe 10% of the properties we bought going into it were not good locations that attracted bad tenants. And so I would say like buy quality. If you're worried about things happening, like get cash reserves, be disciplined with your financing, go up the quality scale a little bit. Don't buy the property that has the big shiny numbers, but it's like really, it's going to attract suboptimal tenants and that sort of thing. So I think if you do all of those, and you had that as your criteria and you go out and you hustle and find, you're going to find some deals. Maybe you don't find as many as you did, but I don't believe in like stopping and starting. I think more like the dollar cost averaging purchase, if people know what that means. That's where you always buy, you consistently buy and when the market's really high, you're probably going to buy fewer. You're not going to buy as many properties. When the market's down, you're going to buy a lot more properties, but you're still always looking to buy. And so I think that's a more logical approach, preparing for anything, being ready, having criteria, instead of saying, I'm out of the market now because I know in 2018 or 19 or 20, things are going to happen. Like I don't see any evidence that any of us can predict those kind of things with any kind of certainty.
No, that makes sense. I mean, you even hear, the Warren Buffetts of the world talk about how they spend almost no time trying to predict macro trends and what have you. It's just not to say that people don't either A, get lucky or, B, just have a great moment of insight or whatever it may be, but to rely on that for your wealth building seems a little challenging at best. But that's great stuff. I appreciate that. And that makes sense. So we need to make sure we have the reserves. We need to make sure ideally we have longer term financing in place and, maybe looking for the better properties in the better areas and certainly maybe not counting as much on appreciation and things like that at this part in the market cycle. So love it. Good stuff. So, once again, like I said, we want to get you out of here. For everyone that wants kind of this amazing playbook, if you will, of how we should maybe think about our financial life, of entrepreneurship, and a lot of great case studies and insights, it's Retire Early with Real Estate. Again, this is Chad Carson. Chad, can you give us your social handles, stuff like that? How can we learn more about you?
Sure. Yeah. So the book itself was published by Bigger Pockets, which is a big real estate community, the biggest one online. So if people have heard of that, they're my publisher. So you can always find the book there on Bigger Pockets. You can also, by September 13th, if you listen to this after that, September 13th, 2018, you'll be able to get it on Amazon, Barnes & Noble, all the other places. So yeah, if having a playbook and a strategy guide to help you kind of get into detail on all these topics today is something you're interested in, I'd certainly appreciate your support and buying the book. And I would love to kind of hear your success story. Like, to me, that's why I wrote the book. Like, it's certainly not like a good return on like your time. Like, I spent a bunch of time, and this is more like a mission. Like, I'm humbled that I have some ideas, and I'm getting to share some ideas that aren't mine. Like, I've just assembled some ideas that other people can benefit from, that you've benefited from, Sean, I have benefited from. And so I just want to get the word out there that it's possible. Here's a strategy. Here's a guide. Here's how to use real estate to achieve some really incredible financial goals. And so the book has the strategy. It has 24 case studies, which was so much fun for me to interview people. Like, I got to, I'm in the South. I'm in South Carolina, in a small college town. Like, that's one perspective from one point of view. I had a really fortunate family situation, didn't have to pay for college because of college scholarship. So like, I didn't want just my story to people like, hey, well, yeah, good for you, Chad. That was really exciting that you did it. But what about somebody who lives in New York City? Like, what about somebody who lives in San Francisco? What about someone who is African-American instead of white male? Like, I wanted to let's get some other stories and show, because it's all sorts of different scenarios where people did this using very similar tools. And so I have Mauricio Rubio in Manhattan has 2 condos, and he and I met. He's just an awesome guy. He has condos in New York City, on Manhattan and Philadelphia, and he's done vacation rentals outside of New York City using like a different little niche, but very similar principles. He saved his money, he bought properties, he's getting cash flow, he left his job, and he's living off his rental income. There's somebody else, Sam from Financial Samurai out in San Francisco. He bought a smaller number of houses, and he wasn't just in real estate. He also bought stocks and bonds and other stuff, but he bought these expensive houses. And the downturn in San Francisco, he did house hacking, all those strategies we talked about earlier. That's how he got into the deals. And the numbers were tighter, but he also had tons of appreciation. So it was fun to share all of these like variety of stories and so whatever kind of situation you're coming from, I think you'll find something there, and hopefully you'll be able to apply it. And that would be the biggest compliment to me, is that, there's some ideas in this book that people email me back at Coach Carson, where I'm my website, and say, hey, Coach, I really got this idea. I applied it. I did it. I'm doing a house hack, or I'm doing a debt snowball. And that's the thing that excites me. And so I hope to get as many people, learning it, doing it, and then following up. Like, I'm on social, I'm online. I've spent a lot of time writing articles. I'm at coachcarson.com. I have a newsletter there. So, you can, for free, come join me there and hang out. I'm also on, if you look up Coach Carson on Facebook and Twitter, and these days I'm testing out Instagram a little bit. I'm not, I don't know 100% how it works, but I'm sharing pictures and kind of more showing me riding my bike to kids at school and kind of more personal stuff. So any of those, look me up, and be happy to connect with you after the call.
Awesome. Great stuff. Great information from a great guy. Really appreciate the time, Chad. And, like you said, check out the book. Really great read. And we'll see you all soon. Thanks so much.
Thanks for having me, Sean. It was fun.
Thanks, Chad.